Workers' compensation is insurance that protects the employee if they get injured on the job. It also protects the employer if they are sued from the employee because the employee got hurt on the job. Workers' compensation is for injuries that are during the course and scope of employment. We're going to talk about workers' compensation from three standpoints. First, we'll talk about it from you, the agent standpoint. After that, we'll talk about it from the employee standpoint when they get hurt. Then we'll talk about the employer standpoint, should they be sued from the employee. Then we'll clean it up and have a few things to learn. This is a relatively quick and short chapter. So from the agent standpoint, what we first do is determine the business's standard industry code. Every job and every job classification has an SIC code, a standard industry code. This helps us classify which business they are, and then the insurance companies can determine the risk. Once we determine the company's SIC code, we then ask for the gross payroll of the employees and for each different job classification. So like all clerical workers go into one category, all construction workers go into another, all managers go into another. So first we'll look at their SIC code, then we'll figure out the gross payroll of each job classification. Workers' compensation bases premiums off of payroll, whereas liability based it off of gross sales. So we'll talk about the payroll of the company. So let's talk about it from an oil change shop's perspective. And let's say at the oil change shop they have 3 employees, 1 cashier, 1 mechanic. We have the gross payroll of the cashier and the mechanic, which the cashier is earning $30,000 a year, and the 2 mechanics are earning $80,000 total. We'll contact the insurance company and figure out how much they charge for each job classification. So like a clerical worker is typically 8810, that's their job classification. And the insurance company then has the rates for all job classifications of, say, 8810 clerical workers. The insurance company's rates are based off of per $100 of payroll. So like a clerical worker is relatively low risk, so their per $100 of payroll might be, say, 10 cents. Or $1. Let's just make it $1 to be easy. So the insurance companies will charge $1 per $100 that you pay them in gross payroll. So if you pay the cashier $30,000 a year, their premiums will be $300 a year for workers' compensation because the insurance company charges $1 for every $100 you pay that employee. Essentially, 1% of their wages are going towards workers' compensation premiums. Now, mechanics are much higher risk than a cashier. A mechanic's rate might be, say, $5 per $100 of payroll. So the mechanic is roughly 5 times more riskier than the cashier. So 5% of their salary is going towards workers' compensation premiums. If we pay the mechanics $80,000 total a year for the 2 mechanics, times 5% of per $100, the mechanics' premiums are going to be $4,000 a year in gross payroll because we pay them more and they have a higher rate. So 5% of 80,000 ends up being 4,000. So to insure the cashier for 1 year for workers' comp, the premiums were only $300, but the mechanics are $4,000 a year to insure for workers' compensation. After we figure out how much the company's supposed to pay a year, which is $4,300 in this scenario. So now that we have the total that the company's going to pay for the year, 300 plus 4,000 equals 4,300. We then have to look up the loss history of the company. The loss history is whether or not they've been safe in the past and whether or not they've had a claim in the past. So this mechanic shop is a low risk down here and a high risk up here. So we have two scenarios to determine what their premiums are. The loss history for the mechanic is known as an experience modification rate. In the insurance industry, we call this an EMOD. The E stands for experience, M is modification, EMOD. But the correct terminology is the experience modification rating. So if the company was unsafe, they'll have a higher experience modification rating. If the company was safe, then they have a lower experience modification rating. So what we first did is we looked up their job classification, then we got their payrolls. Then we contacted the insurance company to figure out how much total they would pay per $100 of payroll, and we got their gross premiums. Next, we looked up their loss history and got their experience modification rating. A brand new company starts at 1. An unsafe company is higher. A very safe company is lower. So like if this mechanic was a safe company, their EMOD, experience modification rate, might be lower at say 0.8. You multiply the gross premium times their EMOD, and that gives you how much they would pay for the year. The experience modification rate in this scenario is 0.8, so they get a 20% discount on their premiums. But if it was an unsafe company, like maybe one of the mechanics got his hand chopped off last year or something, if they were unsafe, their EMOD might be higher. So at 1.5, that's essentially a 50% increase in workers' compensation premiums. So we got their gross payroll, then we got their insurance company's rates, we did the math and added it up together, then we got their loss history and their experience modification rating. The unsafe company pays more, the very safe company pays less. After we figure out their premiums, we've pretty much done our job. As an insurance agent, we don't earn a heck of a lot of money selling workers' compensation because the premiums are so high that the insurance companies try to lower it by lowering our commission. But selling workers' compensation is a very good way of getting in the door to a business, so you can maybe sell them other products that they'll need to help protect them. Now let's talk about it from the employee's standpoint. If an employee gets injured on the job in Texas, they must notify their employer within 30 days that they got hurt. So like, let's say the mechanic was working on a car and it fell off the stilts, the jacks, and fell onto the mechanic and broke his leg. Once you get hurt, you'll notify the insurance company or your employer and say, hey, I got hurt. This guy got sent to the hospital, so they got notified right up front. The Workers' Compensation Board has 15 days to decide to approve or deny the claims for this injured employee. They're definitely going to approve it because this guy was injured on the job. In the state of Texas, though, and most states, I think every state actually, I'm not sure if there's any states that don't, this guy will have to take a drug and alcohol test. So like he got his leg damaged, they're going to draw some blood to make sure that he passes his drug and alcohol test before they actually approve his claim. So they approved his claim. Now this mechanic is trying to recover. Medical bills are covered unlimited for the injured employee. Your medical bills are covered fully by workers' compensation. That's because they want you to get better so you can go back to work. Workers' comp also provides for income benefits, also known as impairment benefits. Impairment benefits are going to be 66 2/3 of your average weekly wage. So it's not how much you earn per hour, and it's not how much other people earn per hour, They're going to take your past 13 weeks of income, and then you'll get paid 66 2/3 of your average weekly wage. So that's how much income you will receive from workers' compensation, known as impairment benefits. Now, this mechanic was hurt pretty bad, so he's going to be receiving workers' comp for a while. The first 2 years of workers' compensation is known as temporary benefits. They're hoping you get better. This is why you're waiting for something called maximum medical improvement, also known as MMI. MMI is up to a maximum of 2 years, and before the comp board decides exactly how much you get for how long, they're going to wait till you reach maximum medical improvement or 2 years, whichever comes sooner. So for example, if you get your leg chopped off, it's not going to grow back. So you've reached maximum medical improvement like on day 1. But if you hurt your back might get better over time, so you might reach maximum medical improvement after 2 years. So different injuries have different MMI times, but the maximum time frame of temporary MMI benefits is 2 years. Then you begin your actual workers' compensation impairment benefits, but they don't last forever. Income benefits, impairment benefits have a limit placed on it depending on your injury by the Workers' Compensation Board. If you've used up all your income benefits, let's say they only approved you for 7 years and you've used up all 7 years, then you can receive supplementary benefits, which only lasts for 1 year. And that's going to be 50% of what you were getting on your impairment benefits. So we'll draw a little timeline. You got hurt, you notified within 30 days. The Workers' Compensation Board then makes sure you do a drug and alcohol test. Then they rule within 15 days whether or not your claim's approved or denied. If you got hurt on the job, you'll probably get approved, no questions asked. Then you receive something called temporary benefits while you're waiting for maximum medical improvement. After you've reached maximum medical improvement, you then begin your real impairment benefits. Your impairment benefits are your income benefits. Your income is 66 2/3 of your average weekly wage of the past 13 weeks that you've been earning income while you had a job. Once you exhaust your impairment benefits, then you receive supplementary benefits for 1 more year, which is 50% of your average weekly wage. 50%, of what you were receiving on workers' compensation. However, in Texas, we have an 8-day waiting period at the beginning of all claims. You never get paid for the first 8 days of workers' compensation in the state of Texas. Most states do have waiting periods. It's to help lower fraud. You don't want somebody who has the sniffles getting on workers' comp just because they got sick on the job. So your income benefits do have limits, but your medical benefits, your medical payments are unlimited under workers' compensation. Now, unfortunately, this mechanic, his leg got chopped off and he was doing well, but then he died. Funeral costs are also covered under workers' compensation. Different states have different rules for how much funeral costs are. In the state of Texas, funerals are covered up to $6,000, but different states have different rules, so funeral costs are determined by the different state. His spouse, however, can receive income. He died. His spouse can receive income for the rest of her life until she remarries. Once the spouse remarries, she would only get 104 weeks of spousal benefits. So what a lot of spouses do is they don't actually get remarried. They just meet somebody new and don't actually get the legal certificate that they got remarried, or else their spousal benefits would stop after 2 years. 104 weeks is 2 years. So spousal benefits are paid out if the employee dies. Funeral costs are also covered, determined by state law. Medical benefits are unlimited, and income benefits are based off of 66 2/3 of your average weekly wage. In the beginning, you receive temporary benefits until maximum medical improvement. Then you receive impairment benefits. If you exhaust all of them, you receive supplementary payments for one more year. In the state of Texas, we have an 8-day waiting period, and you do have to submit to a drug and alcohol test. And once you get injured on the job, you must notify the employer or the insurance company within 30 days. Now, the employee has to be hurt on the job. As long as the employer required them to be there, they're covered. But commuting to work is not covered under workers' compensation unless the employer asks you to travel to a different city. So like I live in Austin, if I'm required to go to Dallas, then I am covered for the one commute to Dallas. But if I'm on a lunch break and I get sick or hurt, or if I'm not at work, I'm not covered. Or if I'm commuting other than required commute, I'm not covered. So you do have to get hurt on the job. Workers' compensation benefits are regardless of fault. It could be my fault or the employer's fault. I still get paid under my workers' compensation. Some states are not required to have comp. Texas, New Jersey, and South Carolina, Texas, New Jersey, and South Carolina, those states do not require workers' compensation for the companies. Every other state are compulsory states where you must have workers' compensation, whereas these are the 3 elective states. Now, let's say that the company is doing business in Texas, and they decide to expand into Louisiana. The Other States Insurance Clause, also known as the Other States Coverage Clause, says that each state you do business in must be listed on the policy. So like if you're doing business in Texas and then you do one job in Louisiana, you must add Louisiana onto the policy immediately, or else you're not covered. And then let's say you open an office in New York, you have to add New York onto the policy immediately. Anytime you do business in another state under the other state's coverage, you have to add each state onto the policy. The reason that's so important is because different states have different rules. Some states you can only buy insurance from the actual state, meaning there's no private insurance companies that offer coverage. Those states are known as monopolistic funds. And since different states have such different rules on workers' compensation, you must add every state you do business in onto your policy, or else there would not be any coverage. Now, Section 2 of any policy is always known as liability. Section 2 of a workers' compensation policy protects the employer if the employee sues them. So let's say that the mechanic was working on the car and it fell off the jacks because the employer didn't have the right jack to hold up the car. The employer has liability limits of $100,000, $100,000, $500,000. These are the minimum you can get. It's $100,000 per accident, $100,000 per disease, $500,000 disease aggregate. A disease is like if the employee contracts cancer on the job. So this employer has 100 on 100, 500, meaning that if the employee sues them, they have $100,000 coverage per accident that was injured. So Section 2 protects the employer if the employee sues them. And this is going to be just an extra coverage on top of the income for the employee. Workers' compensation will not provide for something called punitive damages. Punitive damages are punishment damages. So if this employee did sue in a court, and let's say they won let's say $600,000 from their lawsuit. The employer's policy would pay out the $100,000, and then if they were punished from the court for an amount higher than the damages, the employer would have to pay out the extra punitive damages out of pocket. Punitive damages are to set an example to other businesses. That way they don't have unsafe working conditions. So the workers' compensation policy will pay out the employee's lawsuit, but it will not cover any extra damages awarded by the court over top of this. So punitive damages are not covered under workers' compensation. If the employer is punished by the court, they will not get coverage underneath that. There are also 3 federal acts that are commonly used on your test. There is the Jones Act. The Jones Act provides workers' compensation for people who are injured at sea. So like cargo ships and merchant marines. So the Jones Act is workers' compensation for people at sea, across the ocean, on the water. The Longshoremen Harbors Workers' Compensation Act. So the Longshoremen Workers' Compensation, or Harbors Workers' Compensation Act, provides people who are injured on the docks. So like if you're unloading cargo and you get hurt on the dock, you are the Longshoremen Harbors Workers' Compensation Act. That provides workers' compensation for people who work in like Boston, New York City, Louisiana, people who work in Florida, who work California, receiving cargo from ships and things like that. So if you're on the water, that's the Jones Act. If you're on the dock, that's the Longshoremen Harbors Workers' Compensation Act. And then the last one is known as the Federal Employers Liability Act. The Federal Employers Liability Act is for railroad employees. Railroad employees falls under the Federal Employers Liability Act, also known as FELA. That is workers' compensation for people who are working on the railroad. Now, a cool thing is, if you work on a farm, you do not have to get workers' compensation coverage. Farms have their own type of workers' compensation through a farming policy. So farmers typically don't have workers' comp. They purchase it through their own farm insurance policy. But these are the 3 federal ones. Jones Act is for people who are at sea. Longshoremen Harbors Workers' Compensation Act is if you're at the docks unloading the cargo. And then FELA is for railroad employees, the Federal Employers Liability Act. Workers' compensation will be a relatively small portion of your test, but these are rather important. Anytime you see an employee injured on the job, that is going to fall under workers' compensation.